Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, July 20, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. What can you say other than another very light volume day? The market was basically floating back and forth, up and down, but for the most part just went sideways all day long. A relatively narrow-ranging day. The market still looks like it wants to grind slightly higher. How high does it really want to grind? Well, I think that the 248 to a quarter or 248 and a quarter level, give or take 50 cents or 25 cents on either side, is about it for this move. I'm not seeing anything larger than that on the upside. Of course, it's possible, just not probable at this stage of the game. My intuition tells me that the market will probably continue this float around through tomorrow, which is the expiration day or options expiration. And then next week, we'll most likely see some of the air come out of the bubble. Whether or not it's Monday right away remains to be seen, but nevertheless, I think some of the air should come out of the bubble next week. But before that, my expectation is we'll continue to float sideways to higher for the next day or two, potentially into early next week. You know how I like to look at market symmetry, and while this isn't the best symmetrical picture in the world, it is one nonetheless. So I would say that when you take the move from here up to this pivot high up here, and then you have the pullback, all right, and then you have another ensuing move, we're getting to the point where there's relatively close to equidistant moves between the first up move and then the pullback, and the second up move is around, I think it's slightly shorter than, I didn't really measure it, but just from an eyeballs perspective, it is slightly shorter than today, the first up move. So if there's a little bit more on the upside, I think that would complete, if there's going to be a symmetrical move, it would complete that symmetrical move. That's not necessarily the reason why or where I came up with the 248 and a quarter area. However, it does support the case if you're looking at market symmetry, and I like to look at market symmetry, also called measured moves. While there's not a lot of excitement in the SPDR, and there's not a lot else we can talk about with the SPDR, it's basically the same routine day after day. Since we made the low around 10 days ago, right around 240.75, we tested this level a couple of times, and then we took off to the upside. As it stands now, we're about 60 handles, 60 S&P handles, roughly, give or take, from that point, which was just about 10 days ago. That's quite the move in the S&P in just, a week and a half, 2 weeks worth of trading. So it stands to reason that the market's a little bit overbought in the short term, a little bit, as they say, long in the tooth, and therefore it stands to reason that we're probably going to have some kind of a pullback when options expiration passes by, and I think we get back to reality. But this also supports the case, and why I tell you time and time again, even though we have what I believe to be in the time zone for a cycle top, we don't necessarily take any short positions on the index, any meaningful positions in the index without the signal where the market is telling us it's ready to change character or ready to make a turn. We don't have that, and until and unless we do, we let the market go higher, and basically, and I've said this many, many times over the last few weeks, the trend is your friend until the very end. That's always been a market mantra. It always will be a market mantra. You don't fight the trend. It's basically a fool's game. Now here's the IWM, and what I find interesting about the IWM is we are at new highs in the IWM. So we'll see how high this market wants to go, but here's the rub. When you look at the longer term chart, all right, I'll go over to the weekly first, and you'll see that this upsloping trend line, here we are again, and it's going to come into play in a very big way, in my opinion, based on the closing of the month of July. Each and every month that the IWM challenged this trend line, it failed to close above the trend line. It will be very interesting to see this month if they're able to close this over the trend line or they're not. And what's interesting is we're right in the zone for a cycle turn. So I find it fascinating that the IWM, which is my favorite leading indicator of the market, is challenging the upsloping trend line that's been intact all the way back from 2011. It looks like it's going to be a photo finish or a race to the finish line between the upsloping trend line and the IWM. But the positive for the IWM on a closing, the positive for the IWM now is that we are at new highs, and therefore we're either going to see one of two obvious things play out. Either a breakout with further upside potential, or a failure at these levels, and it's going to come within days, most likely within a few days, or even within, let's say, 10 days, which would be the end of the month. So we have 2 weeks for the IWM to make its case on whether it's going to break out to the upside or whether it's going to fail at the trend line. Very interesting scenario in my mind. Going over to the transports, which is my other favorite leading indicator of the market, we have continued divergence in the transports. Now, 3 days in a row being down, this now has my attention, and we're now back. Look where we went today. We came back to retest the last breakout point, which was when we got above and closed above the red candle high that we talked about quite a bit. And I said, if we get above on a closing basis this red candle high, that's going to mean more upside for the transports, and that was a failed bearish pattern, which is very important. We did see the upside, and just in 3 days, we came back to retest that last breakout point. Markets like to come back to retest former breakout points. Some of them can be termed the scene of the crime. I guess you can call this a scene of the crime. It's not my favorite look to a scene of the crime, but nevertheless, we came back to retest this breakout point, which I find extremely interesting, and it's interesting coupled with the fact that the transports are diverging from the IWM and the spiders. The IWM and the spiders were at highs, and the transports are selling off. Is this the canary in the coal mine that we're looking at right here, right now? I think it may be a tell for what's coming sooner than later. And I'm not suggesting we're going to see the ultimate turn starting Monday or Tuesday in the market. However, I think this is a little shot across the bow in my mind with the Spider and the IWM and other indices powering higher all week long, and today was a flat day for the most part. The S&P was down less than 1 point, and the Dow was down 29 points. These are rounding errors, but when you look at the transports down 1% or 92 points, that's a different story. Generally speaking, there's always one market that tends to give you a signal of something else that's developing, if, in fact, there's something else developing. And right here, I believe the transports are speaking to us a little bit, and we'll see what happens on the rest of the markets. But this is something that we have to pay very close attention to going forward. I think it's the canary in the coal mine in the short term. We'll see if I'm right. One other thing that I talk about from time to time, and I think it's worth mentioning tonight, is the VIX. And the VIX, while down a little bit more than 2% today, we're down below the $10 level. Each and every time we get down in this zone, and I talk about this each and every time we get down in this zone, when we get down below 10, whether it's 9, whether it's 9.5, in this neighborhood, it's generally a buying opportunity. It doesn't stay down here for very long, and the one thing that traders have a difficult time with is when the market looks like it can't go down. It looks like it's just going to continue higher. That's the market's way of sucking in as many unsuspecting participants as it can The more bullish sentiment becomes, the more likely we are closer to a top. That's the way the market works, and it works on the flip side as well. The more bearish the sentiment is, the more closer we are to a bottom. Right now, we're getting to the point of an extreme in terms of sentiment, in terms of the VIX, in terms of the price of certain markets, the IWM, the SPDR, or the S&P, and the list goes on. And with that being said, it stands to reason that as long as the VIX is below 10, I'm okay with taking positions from a long-term perspective if you're so inclined to buy call options on the VIX or use any of the exchange-traded products that are long the VIX. I'm okay as long as you have the time and the patience. Maybe the VIX goes down to 8.5. It doesn't really matter to me because my thing is that come September, October, maybe even into November, there's no chance the VIX is going to still be down here. It may be down here by then, but we'll have spiked higher before that comes around again. When you look at this, each and every time we get down to this area, we find ourselves trading higher just days away. And frankly, there's just no reason that this time will be any different. And this goes to when you find out that a lot of people, a lot of traders, a lot of investors tend to do the wrong thing at the wrong time. We've all done that. We get sucked into something where we don't want to miss the run, or we short the market and we don't want to miss the drop, and it turns out that we shorted it when it was down too much and we get it in the face. Or on the flip side, we buy into a rally and we buy close to a top and then the market drops and we feel stupid. And I get all that. Everybody's done that at least one point or more. But the hard thing to do, that's the easy thing to do. Doing the wrong thing at the wrong time is easy because most people do it most of the time. The hard thing to do is doing the right thing at the right time because it feels so bad. And that's the difference in the market. And that's the game the market plays with our mind and our emotions. Being able to do the right thing at the right time, even though it feels wrong. And this goes to what I'm talking about in the VIX. Even though the market feels like it's going to continue to go higher, it feels like we shouldn't be short the market, and we shouldn't until a signal. That goes back to what I said 100 times before. However, the VIX is slightly different because the VIX can spike out of nowhere, and it's just not going to stay down in this zone for very long. Could it go slightly lower? Of course it can. It can go down in the 8s, absolutely. But that doesn't mean it's going to stay there long. All right, let's move on. Market psychology. Very, very important. Very, very difficult topic for most traders, most investors to wrap our head around. We know it's an important component of trading, but it's not so easy to get it right. I get that. That's common and normal behavior. Or feelings, I should say. All right, let's move on to the gold market. And where did gold go today? Well, it went to the number that we've been talking about for a while. It went as high as 1247 spot 20, but the number that we've identified was 1245. I said we should get there. We got there, pierced through it a little bit. We no longer need this trend line. We should, as long as gold can maintain in this upper range. And what I mean by that is, if it's going to consolidate in a bullish fashion, so another few days of sideways activity like this, then it would be building energy to get up to the next level, which is 1260. And we'll see if that's the case or not. But if it decides to pull back, it could be just a pullback pattern developing another ABC corrective pattern that we saw in crude oil, which we'll talk about again in a couple of minutes. But now we're above the 200-period moving average as well as the 20-period moving average, and it's obviously more bullish than it was before. But we know the ultimate or very important level, which is a daily close above the 1242 spot 60 level, this red candle high. That's an important close, and we'll have to see if gold will close there today on the daily chart. And I'll put that in and we'll leave it there and we'll see what happens. Or we'll put a different line in because that one wouldn't work. All right, moving over to the silver chart. Silver was up fractionally today. The chart looks very much the same. We are beginning to potentially consolidate sideways. Same routine. If we do for another few days, it will be building energy to trade up to challenge really two areas, but they're almost the same. This red candle high and the 50-period moving average, which is the blue sloping trend line. Charts look very similar, almost identical. They're trading in tandem, and generally speaking, gold and silver will trade in tandem, not necessarily each and every day, but in the large picture, they typically trade in tandem. How about crude oil? Crude oil, technically, as far as I'm concerned, today completed the ABC corrective pattern. I know you're getting tired of me drawing this in, but one more time, and this is the last time. So we have the A leg, the B leg, which is down, not that way. Let me redo it. All right, that's our ABC or zigzag pattern as it's called. And what happens is not the close, but the spike above the high of the A leg, which came in at the 47.45 level. Today's high is 47.74. In my book, that completes the pattern. The ABC is off the table in terms of a pattern that's still developing. It's finished as far as I'm concerned. However, we could still trade higher in crude oil. And one of the things we want to pay attention to are trend lines. And I'm going to draw a trend line in. And this one is also courtesy of one of our traders, Jordan S., who is a very good student of the markets. And it's certainly worth mentioning, and I find something extremely interesting also. So you can draw trend lines a couple of different ways, and it's debatable on what's right and what's wrong, and that's what makes markets, right? So everybody has a different way, a different number, a different, thing they look at, a different moving average. And, the market always hits somebody's number, somebody's line. But here's what I would normally do if I was drawing a trend line. I would draw it from pivot to pivot. And that comes in at roughly the 48.50 area, give or take. And we've been talking about 48 to 48.50. And where does that come from? The high here is 48.66 of this red candle high. So that makes all the sense in the world that would be an area that would provide resistance to the market. So there's another way to do it. And let me just redo it. And I'm going to show you something interesting. And this actually happened today if you were to draw it this way. Now, I'm not saying this is right, this is wrong. I just find it interesting. So if I just took the trend line down a little bit, well, let me redo it I'll do it from a different point. I'll do it from the close up here, or the open. This was the opening price on this day. It's close enough. And you just do it not from the wicks, not from the tail of the candle, but I'm doing it from the top of the body of the candles. Well, I did it before and it came out, I don't know, I guess I did it incorrect before, but it came out, the way I did it before is actually touched the top of today's wick or today's tail, and I thought it was interesting. It didn't necessarily work that way out when I wanted to explain it to you. That's like bringing your car in because you hear a noise, and when the mechanic takes the car for a test drive, there's no noise. Well, that's what just happened to me, so obviously I feel like a fool, but nevertheless, the trend line holds true one way or the other. The market or crude oil is trading up into a very obvious to me resistance zone. You have a downsloping trend line. You have the red candle high that comes in over here at 48.66. There's all the reason to consider that crude oil with a little bit higher push will stall out at that level and have some kind of a meaningful pullback. And by the way, that little faux pas is what happens in live TV, folks. That's okay. I'm sure you'll give me a mulligan. The bond market. So here we are again, and the bond market was up today, but look where we're going. We pierced through the trend line again, the upsloping trend line, but we backed off of it, and now we're below the trend line. I find it interesting. Keep in mind, the trend line, obviously, because it's upsloping and each and every day the market goes on, it's a higher price. The trend line comes in at a higher price, and today the market's edging higher. We still can't close above the trend line. I find it interesting. I find it fascinating. We'll see what happens with the bond market. The way it's acting here, I don't see it getting above the trend line. I could be wrong. I'm just reading it from a visual perspective, and I'm looking at it and I'm saying they had, over the last couple of 3 days with that big surge from Tuesday, they had every opportunity to get above and stay above this trend line, and they just weren't able to do it. That tells me that this trend line is extremely important to the market. Remember, the market draws the trend line. It's not you or I that draw the trend line. The market is telling us that this price level is important as a result of the trend line that the market drew, as a result of where price stopped, creating the pivot down here in this area, and that's what gave us the ability to draw in the trend line. And you can see what happened when we came down. We did stop short on it that day. The next day we fought it, which was a Monday. You can see the space here. And then we traded lower, and now we're rallying back to the underside of the trend line. That should be obvious to everybody that the trend line is important. All right, going over to the dollar, and the dollar got hammered again today. The other day I mentioned a possible downside target on the dollar is 93.5, I think was the number I gave you. We'll call it 93 to 93.5 in that zone, and it certainly looks like that's where the dollar is headed. Again, just to be clear, long and wrong the dollar. However, by the end of this week, I will make a decision whether or not I'm moving out of the trades that I have put on the dollar, or the long trade on the dollar, and just maybe step aside, let it play out, let it give me a reversal signal or some kind of a reversal and then a pattern to play off of, and I'll be happy to get back in, but I just don't want to be long and wrong past the 93 level, that's for sure. And with that, I'm going to wrap it here tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.